What if everything you believed about home ownership was built on a lie you were never told? Not a conspiracy, not a cover-up, just a history lesson nobody ever gave you. Because most Americans believe home ownership became unaffordable because houses got too expensive, or because owning a home became a bad investment. But that's not what happened. What if the truth is this? The entire system that once helped the middle class build wealth quietly disappeared, and almost nobody noticed. Because here's the truth that changes everything. The people that are building generational wealth right now are not smarter than you. They're not luckier than you. They just understand something about the American mortgage that most people in 2026 have never been taught. And the people who don't understand it, they're going to spend the rest of their lives paying someone else's mortgage, not their own.
Yeah, and here's the number that should make you stop scrolling. The median American home today costs 5 times the average annual household income. In the 1940s, that only cost 3 times. So that gap, it's not by accident. That gap is a direct result of a generation that simply forgot what the tool of homeownership actually was. And right now, in 2026, the same separation that happened in 2008, it's happening again. And the builders, they're continuing to buy, but the waiters, they're renting. And most people, they don't even see it coming.
So today, we're taking you through the entire history of the American mortgage, from the moment it was invented to the moment it was almost destroyed, to what it looks like right now in 2026. Because once you understand where this tool came from, you will never look at home ownership the same way again. This is the Mortgage 101 podcast, and this is the history lesson that could change your financial future. Before 1934, if you could not pay cash for a house, you didn't own one. Full stop. And most people, they could not. So most people, they did not. The average American family in 1920, they rented, period. They built no equity. They had no security. They got evicted when the landlord raised the rent or when the economy turned. This was normal and this was life. And here's what people think today. They think mortgages have always worked the way they work now. They think a bank has always been willing to lend you $300,000 over 30 years at a fixed rate. They think this is just how lending works. Well, it's not. It's not even close.
Exactly, Manley. I mean, what actually happened before the Great Depression, it was pretty brutal. A typical mortgage was a 5-year balloon loan. You borrowed 50% of the home's value. You paid interest only for 5 years. Then the entire principal was due. All of it. In one lump sum. If you could not pay it, the bank just took the house. If rates went up, you refinanced at that new rate. And if rates went down, tough luck. You were locked in. And here's the part that kills me. You had to put down 50% cash upfront just to get the loan. 50%. That means homeownership was exclusive to people who already had money. The middle class, they didn't stand a chance. The working class, they didn't even know what a mortgage was.
So, people rented. Generations of people rented. They paid landlords. They built nothing. And then 1929 hit. The market collapsed. People lost their jobs. People could not pay rent. They got evicted. Banks failed. People's savings vanished overnight. The entire system seized up. And the government watched this happen and realized something terrifying. If regular Americans cannot own homes, the entire foundation of this country is at risk. Home ownership was not supposed to be a luxury. It was supposed to be the engine of American wealth. Because the goal was never just shelter. The goal was home ownership. The government realized something dangerous. If ordinary Americans spent their entire lives renting, they would never build wealth. They would work for decades and own nothing at the end of it. So, the American mortgage system was redesigned to turn workers into owners. And for generations, it worked.
Yeah, and here's what most people don't even realize. The mortgage as we know it today, it did not come from Wall Street trying to make a quick buck. Not even close. It came from government deciding that regular Americans deserved a fighting chance. And that is the moment everything changed. In 1934, the FHA was created. Stands for the Federal Housing Authority. And it came with something that's never existed before in American lending history: a 30-year fixed rate mortgage. You could borrow 70% of the home's value over 30 years at a fixed rate that did not change ever for the entire loan period. This was not by accident. This was not market forces. This was simply a deliberate invention designed to give American middle class a tool they've never had before.
Excuse me, I think you forgot my bread.
Bread, $2 extra.
$2, but everyone in front of me got free bread.
You want bread?
Yes, please.
$3! What? No soup for you.
Let's rewind the clock. Let's go back in time to how mortgages actually worked after World War II. So we've got this tool now. 70% loan to value, 30 years, fixed rate. For 70 years, regular Americans built generational wealth, but here is what made it actually work. The entire structure underneath it was different. After World War II, nearly 40% of American workers came home with guaranteed corporate pensions. A factory job was not just a paycheck, it was a pension promise. Your employer promised you income for life. That promise meant banks could safely lend you money over 30 years because they knew you would be earning stable income until you died. The government handed soldiers zero-down mortgages. Housing costs 3 times your annual wage. A factory job, that represented 38% of all American employment. This was not just a mortgage system, it was a complete structural ecosystem designed to let the working people build wealth.
Yeah, and that's the part that modern Americans completely miss. The mortgage was never supposed to function like a credit card or a car payment or consumer debt. It was designed as a long-term wealth-building machine for ordinary families. Lock in the payment, own the asset, and let time and inflation do the heavy lifting. That was the entire point. And the people who understood that, they quietly built generational wealth while everyone else focused only on monthly payments.
2008 proved it. 2008 was not a mortgage crisis. It was a structural collapse. Millions of Americans refinanced into adjustable rate mortgages, chasing teaser rates that exploded after 2 years. They took cash out to buy cars and vacations. They bought at the peak thinking prices only went up. They treated their homes like ATMs instead of tools. But the people who stuck with their original 30-year fixed rate mortgages, who did not chase those variable rates, who did not take out balloons, they kept their homes. They kept building equity. While chaos happened all around them, they were protected. Some even refinanced smart into another solid 30-year fixed at a lower rate. That is wealth building. That is playing the game right.
That's right. And let's look at the 2026 era. Housing costs 5 to 8 times your annual income, double than what it was in the 1940s. Guaranteed corporate pensions, yeah, those are gone. Under 10% of workers now have them. Every worker is entirely responsible for their own retirement now through 401ks. That means every dollar a buyer saves for a down payment is a dollar pulled from their retirement. They are now forced to choose between homes today or retiring securely tomorrow. Meanwhile, they're competing against institutional investors with unlimited cash and high-income professionals who don't need to make that choice. This is not the same game anymore. The rules have fundamentally changed.
And that is exactly why understanding this history matters right now. All right, here's the truth. If you do not understand mortgages, you will be a renter forever. That is not a prediction. That is a fact. The people who build American wealth understood one thing. A 30-year fixed rate mortgage is not debt. It's the only tool that lets you own real assets while inflation destroys cash savings. Your payment stays the same. Your income goes up. You build equity. Your landlord's rent keeps climbing. That's why ownership matters. Because in America, inflation punishes renters, but it often rewards owners. The person renting pays more every single year and owns nothing at the end. The person with the fixed rate debt slowly watches inflation reduce real costs of their payment while the value of their assets rise around them. That's not luck. This is how the system was originally designed to work.
Yeah, but here is what separates the builders from the renters. The builders, they understand discipline. They get a 30-year fixed and they do not touch it. They do not refinance into ARMs. They don't chase teaser rates and they don't take cash out. They lock in at a rate and hold it for 30 years while inflation does the work for them. Whereas the renters, they're still waiting for rates to drop. They're still convinced prices will come down. And they're still playing the timing game. And every month they wait, their purchasing power, it evaporates. Every month they wait, their rent, yep, it goes up. And every month they wait, someone else is building equity in the home they could have bought at a better price.
In 2026, here's what is actually happening. Institutional investors are buying real estate at record levels because they understand something most Americans do not. They understand that the fixed rate debt attached to a hard asset becomes more valuable during inflationary environments. Meanwhile, most renters are doing the exact opposite. They're holding depreciating cash, they're paying rising rents, and waiting for a housing crash that may never come. And every single year, that wait carries real financial costs. The average renter in America is now spending over $20,000 per year on rent with zero equity in return. Meanwhile, the median homeowner gained more than $125,000 in equity growth over the last 5 years alone. That is the separation happening in real time. And the craziest part? Most people still believe waiting is the safer decision. But the longer you wait in an inflationary system, the further behind you fall.
So here is what all the listeners need to do this week if you are renting. You need to stop waiting. And you need to get approved, not to buy tomorrow, but to understand your actual buying power. Because the moment you see your approval letter, everything changes. You stop being a renter who hopes and you become a buyer who acts. And here is the reality you need to accept. The people who make this move in 2026 are going to separate themselves from the people who do not. The builders, they will own. The waiters, they will rent. There's no middle ground anymore. That unicorn is dead. Prices are not coming down. Rates, they're not going to magically drop. You either accept reality and act, or you can keep waiting and accept a lifetime of rent payments and regret. The choice is yours.
Come on. Come on. How much longer?
Anthony, let's check in on where the market actually stands today, because this is exactly what we've been talking about.
Yeah, let's get at it, Manley. The 30-year fixed rate, it's sitting at 6.60% as of today, June 1st, 2026. That's up 4 basis points from yesterday. The 10-year Treasury yield, which sits at the single biggest driver of where the mortgage rate goes, it's at 4.49%, also moving up. Now, here's the number most people never hear about. It's the mortgage spread. The gap between what the bond market says rates should be and what you actually pay at the closing table. That's about 2.57%. That's crazy. That's fear premium keeping your rate artificially elevated. So when that spread compresses, rates, they drop fast. And guess what? There's a lot of volatility right now. So that spread is going to be sticky.
Anthony, bottom line, the market is moving. Waiting for perfect is costing you money every single day.
He's just having a hard time getting his confidence back.
Many months later.
I'm sure he's close to a breakthrough.
Here's the full circle moment. In 1934, the government invented the 30-year fixed rate mortgage because regular Americans, they deserved a fighting chance. The people who used it built generational wealth. The people who forgot it, well, they lost everything. The people who understood it in 2008 kept their homes while everyone else lost theirs. And right now in 2026, the same separation is happening again. The builders are buying, the waiters are renting, the history, it's repeating itself again. And the only question is, which side are you going to be on?
We are Anthony and Manley, and this is the Mortgage 101 podcast. If you got any value out of this episode, like, follow, and subscribe, and help get the word out. And also, share this with the caramel macchiato generation, the ones sitting on the sidelines convinced homeownership is not for them. Tell them this is their wake-up call. This is not your grandparents' mortgage era anymore. The rules, they have changed. The tool is more powerful than ever, and the time to act is now. We'll see you next week.
Girl from the heart of Wisconsin to the waves of Hawaii. Manley and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home and laughs. Manly's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast.